The big question that we have looming over the stock market is, are we going to see a recession in 2023 or not? That's something that I would like to take a look into GDP to see what exactly is going on with the forecast, what we have, and what that means for the rest of the year 2023. I have a spreadsheet prepared for you. We're going to take a look at it just to see how the numbers work out across 3 different sources. Leading into us checking out those sources, I'd like you to check out this offer from Moomoo. You can find the link down in the description. Click sign up and deposit your cash and get up to 15 free stocks based on the amount that you deposit. $100 will get you 5 free stocks. $1,000 will get you 15 free stocks, each valued up to $2,000. Take advantage of that offer before it goes away. Also, if you'd like to hear more of my commentary, make sure you check out that link for the Patreon down in the description to get access to my Patreon exclusives and be a member of my private Discord community. Now, with that said, over to the GDP now. Federal Reserve Bank of Atlanta, latest estimate for Q1 GDP, 2.5%. And what you need to know is that that is actually multiplied by 4 to make that number that you see. So really, it's about 0.625% GDP from the previous quarter. When we look at that number, you'll see more of that in our spreadsheet. So that would be a very solid number for us if it was expected to hold out throughout the rest of 2023. And I think that there's a lot of consensus over seeing weakness, but not necessarily seeing recession. That's the part that's hotly debated through this. So the IMF, the International Monetary Fund, actually has the US coming in to close out the year at 1.6%. That's by the end of the year, not just for Q1 coming up. And we'll also look at what the Fed has for that on the spreadsheet that I have made up for you guys to take a look at and see what you think of that. And then we have the conference board. They are by far the most bearish that we have. They are currently seeing GDP growth to slow down to 0.7% in 2023, and then it says then rise to 0.8% in 2024. So let me bring up the spreadsheet for you. We'll take a look at that. We'll go over some of the details that we have. All right, so here's the spreadsheet, and you'll see the 0.625, and that was a percentage that I mentioned earlier when I said the 2.5% that we see on the Fed now, or the Fed GDP now. 2.5 divided by 4 is where we get that 0.625. So this is isolated back to Q1, and you can see what that looks like across the remaining quarters, that we get just slight economic contraction, pretty much no growth whatsoever, with just a little bit of contracting, taking us to this SEP, which is Summer Economic Projection Median Estimate. So this is from the Fed back in March when they put out their Summer Economic Projections. This was the median value that they saw, and a significant amount of change has happened since then. So we'll see if that does take place. Inflation ticking down could be one of those helps that we get, and also leading to a more dovish Fed, and maybe we get a little bit of more strength coming into the economy from that. We'll have to watch and see. If we hit the SEP's low estimate, the Fed's estimate from their SEP, which was negative 0.2%, we get significant contraction following a read of 2.5 if the Federal Reserve of Atlanta is accurate with their 2.5% for their GDP now. So you could see 3 quarters averaged out to about 0.25% each, about 27 basis points for each one. And if we hit their high estimate of 1.3, now we're closing in on what the IMF has of 1.6. And you can see we do get slow growth for that. Each one just shy of 0.25%. Again, that's linearized. It doesn't necessarily happen evenly like that. If we do see that sort of slow down, we're probably going to see a lot of it at once, and then maybe some tapering off from there before we see strength come back to that. Now, this one is the IMF estimate. Here, I'll put it in the middle of the screen for you. And so for the IMF estimate that we have here, based off the Fed's GDP now estimate, leading us at 1.6, you can see we do get slower growth, but it is growth the entire time. So there is an interplay taking place here that I want you to be aware of when you look at these numbers. It's not just the Fed GDP now estimates that we have. That's one piece of the puzzle. The other piece is where we see the end of Q4 going in that year ago quarter number. That's going to be a huge impact for us. Basically, the higher we get for Q1, that really puts pressure on where we fall for that ending value, for that year ago quarter value. And I'll show you that in the spreadsheet. And let me bring that back up for you. So for the conference board, they're only seeing about 2% taking place. So 0.5% when we do just for the quarter, whereas Fed GDP now has it as 2.5. Now, this is from April the 12th when we look at this, and that's before the CPI and PPI came out. So their analysis is a little bit dated compared to what the Fed GDP now has. Maybe they would change their tune a little bit on that. So this is coming from the Conference Board's estimates, and you can see that these are their predictions as well. So they have a negative 1.8 divided by 4, negative 1.8 divided by 4, and then the last one is negative 0.6 divided by 4. And that's where we see these values come out here. And you can see what happens when you look at year-ago quarter values. That would be significant contraction if we see what the Conference Board expects to see according to their estimates. That would, I think, is the most bearish that I've seen. All right, so on the spreadsheet, I said I would show you that there is pressure on Q1 and how it impacts the results that we see for Q4. So what I want to do is here, instead of having 2.5%, like the Fed GDP now says, I'm going to change it up to 12%. I do not expect that to happen, but watch what happens to these other numbers, these negative 0.07% that we have. As soon as we have a really strong first quarter number come in, that puts pressure on a higher value. Now, mind you, it makes it more likely that we have that higher value, but the reason that I tell you this is that if we hear these weaker numbers come out for Q4 for the year-ago quarter values to end the year, that's troublesome. And so that might help explain what we see with the markets depending on what sort of numbers we get here. Now, this is very, very extreme to jack this up to 12%. That'd be just 3% quarter over quarter. And well, you can see what happened before that. We're not going to get that value. So I picked a number that was high, not realistic, so that you could see how much pressure, even though I didn't even change where we end, it changes everything that's in between. So let's go something more reasonable. Let's go with 5 instead of 12. It's more reasonable, not quite reasonable, but you can see this number dropping here. If we go back to the 2.5%, there we go. So if we get a really strong number for Q1, but they don't change the end results for the projections for the year-ago quarter, when we look at Q4, where are we going to end that year, the GDP year over year? That's something that we really want to pay attention to, because you can see if we end year-ago quarter above 0.4, if we get that 2.5%, we end the year pretty much even with no growth, which isn't ideal. We want the economic growth to take place. However, we pretty much avoid recession if we come in above that 0.4%. If Q1 comes in at 2.5, we're going to have to watch the revisions as they take place. So if we come in weaker than that, though, I'll show that as one other thing. Let's take this down to 0, saying that there was no growth this quarter. There we go. If there's no growth, well, then check it out. Once again, if we would end at that 0.4%, we actually have growth over the next several quarters. So it's possible then that we avoid that recession as well. So watching these numbers come in, it's not all about Q1. It also is about where we see the rest of the year going. Back to full screen so you can see this gorgeous face of mine. So whatever we see for Q1 for GDP, I will update the numbers that I have in this spreadsheet. We'll see where that lands us based on the year-ago quarter projections that we have for the end of 2023. That is going to be really impactful in trying to decide, are we on a path that we're going to see that recession take place or not? Because that's the big question that's out there. Right now, according to the median estimate, very mildly so. According to the low estimate from the SEP, very moderately so. If we get what the Conference Board has out there, which I think is a little bit bearish, then, well, most definitely so. That's the strongest case for recession. Now, they come right out and they say, we believe that there will be a recession in 2023. However, when we look at the IMF's numbers at 1.6, which they say isn't necessarily an estimate for them, but it is one that they see as a possibility, gives them something to work with, that we actually come in with decent growth, even though it is slower. It's not at 2%, it's not at 3% for the year, but 1.6% for the year, somewhere between 1 and 2. We're actually in okay shape for that, and at least on a linear basis, that we have evened out growth values from Q1 to Q2 to Q3 to Q4. Well, then we avoid the recession. So we're going to have to watch and see as those numbers come out. But I did want to share this with you, and I will absolutely be paying attention to those GDP values that come out. And we want to absolutely watch what's going on with retail. We want to watch what's going on with housing. They're going to have a big impact on our GDP numbers and helping to determine whether or not a recession really is in the mix for us. So if you guys like my commentary, make sure that you check out that link in the description for the Patreon. Click the link, sign up, get access to my Patreon exclusives, and join me and my community members in my private Discord. We'd absolutely love to have you over there. Also, don't forget about that link for Moomoo. Sign up, get your free stocks, and access to just a wonderful trading app that can help take your investing game to the next level. I am Dr. Stock, Doctor of Education. We'll see you in the next video.